Finding an analyst who truly understands Tesla and who runs the numbers, builds the models, and backs every claim with hard data is almost impossible to find. Today, we're joined by AJ, an analyst known for his clear, disciplined approach to understanding complex markets. He has a simple but effective framework he uses to project where Tesla's share price should trade. In this interview, AJ will break down Tesla's potential upside over the next 12 to 24 months, what could drive it, what could derail it, and how investors can think about the road ahead. AJ has a background in finance and physics. Before he became active on X providing independent financial research, he retired from investment banking where he advised public companies on mergers and acquisitions and other capital market transactions. AJ will be speaking to us off camera since he prefers to stay anonymous. Welcome, AJ. Thank you for joining me again.
Hi, Herbert. Thanks for having me back.
Yeah, this is, I think, our fourth or fifth time we've been together. The audience loves it because you uniquely, compared to most other analysts, you actually have incredible amount of work that you do. I don't know of anyone else who does the deep dive, the detail that you put into your spreadsheets. But today, you're going to talk mostly about stock because you have a unique way to value. And I think your perspective is very important for Tesla investors to understand how you determine what the true value should be, right?
Yeah, exactly. Today, I wanted to share some insights on how to actually handle this topic, because I think it's a very important topic. A lot of people have invested a lot of money in Tesla, and because the stock tends to go up a lot, goes back down a lot, it creates a lot of anxiety. So I try to provide a quantitative view in this video that provides more insight in how actually things work. And I have to give a warning. I will be saying a number of things that will offend long-term Tesla hodlers, because I will shatter some of the myths that are out there. And so this will be a bit controversial, but I will try to back everything up with data. And maybe we get right into it. So what you're looking at on this first chart is basically Tesla's share price. You can see this here in this grayish line, this jagged line down here, and you can see this peak. I call it the Trump bump. This is after President Trump won his second term, and we had this huge Tesla rally, which kicked off slightly before November 5th, 2024, and then with this huge rally, and then stock obviously came back down and then bottom in April during the market bottom this year, and then traded up again. And so this is basically just the share price, and here on the right-hand side, on the left-hand side, you can see in dollar the value of the stock, the scale, and then now we get to these red lines and these green lines. The central gray bar is actually not that important, but we'll talk about it also in a moment. And so what these lines represent is they represent, so the green lines represent a range around the median trading range of the stock. And I will explain in a second what I exactly mean by median. One-time standard deviation. So one-time standard deviation captures a spread that occurs quite frequently. And then the red lines, they mark plus and minus 1.5 times standard deviation. And that it is a wider funnel and captures also less frequently occurring events. And what this is based on is on a observable multiple. And we discuss later in a moment exactly how to derive that multiple. It's a forward multiple. You can see it also here in the headline. So every point you see in this entire long time series, not only historically, so going back to 2021, 22, 23, 24, but also forward looking. It's all based on a forward looking multiple. And the way to calculate is you take the share price on a given day. Let's say here, this is August 2023, share price was here, when you look at this line, was around $250 per share. And what was from that day's perspective, the next 12 months earnings, and that gives you a multiple, and that multiple, of course, varies all the time. But if you do this exercise just from today's perspectives over the last 12 months, and you look at where the median forward-looking multiple was over the last 12 months, you can basically assess the median level, and we'll look at the multiple in a moment. And then you can keep this multiple constant. And then when you project earnings forward, you can create this corridor by applying this constant multiple to the earnings that you project. And this is how you can construct this corridor. And then this green and red lines you can construct by calculating the 1 times and 1.5 times standard deviation around that median. So this is basically high level how it works. And when we go into the multiple, because again, right now we're just looking at a share price corridor. We don't look at the multiple. We look at the multiple in a moment. And let's just have some quick observations. You can see that over the last 12 months, so this is about this area from here, November 2024, till the current period, which is November 2025, you can see that this corridor that is basically overlaying the share price captures quite well sort of where the stock typically trades. You can see during the Trump bump, the stock traded quite outside the corridor, which is by design, because you want to see where the stock gets out of line, either too high or too low, relative to where it should be, based on what was observable over the last 12 months. And when you look at this chart, it actually quite precisely predicted a sell point. Clearly, when there was this Trump bump, stock got substantially ahead of itself. And we look at it in a moment in terms of valuation, in terms of multiple, what that meant. And then during April and March, it oversold. It got outside the normal range, and then it recovered. And then recently, we had this spike, and this spike was caused by Elon buying Tesla stock. And that caused a huge rally, and the stock yet again got outside of the range and then pulled back. And then but then when you look at this, you will also notice that, oh, hang on a second, when you go back further into the past, the corridor was completely off. So this is not really working, but this is by design, because remember, this methodology is calibrated for the last 12 months observable forward multiple. And the way to look at it is, when you look at this, is okay, it works for the last 12 months because this is the calibration. But when you then compare to prior periods, the point is that the sentiment was much lower. But if you applied the current sentiment, which is much higher, to the earnings that were delivered in the past, the stock actually would have moved up to $700 or $800 a share. Because in the past, around end of 2021 perspective, the earnings outlook over the next 12 months, so 2022 earnings, were much stronger than current earnings. But if we had at the time the same sentiment, the same strong sentiment or high multiple, the stock would have been $700 or $800. That's the key insight here. So it's basically that's just a very long-winded way of saying we are trading right now in a very high sentiment environment. And I think it becomes even more clear. This is just a zoomed-in version of the chart. I want to skip real quick to the multiple. Yeah, here's the multiple. So here we now look at the valuation in terms of PE ratio, forward PE ratio, and you can see that during the Trump bump, the stock touched almost 280 times forward earnings, which is extremely high, and was a strong indicator that the stock would likely pull off. And then the other thing I'd like to point out is that before the Trump victory, Tesla actually never really traded up to that high level. For example, this line, this dashed line down here shows you the last 12 months median multiple just before the Trump victory. That multiple was 99 times. So there was a much lower sentiment. And afterwards, it's always easy to explain these things. But obviously, during the prior administration, Tesla, Elon were probably seen as having potentially more political resistance, etc. But anyways, whatever it was, the key point is that sentiment significantly increased. And the key observation here is that the stock now for an entire year held, and you can see this here on this teal colored line. That's the
180.
median over the last 12 months, and it's 184 times.
Yep.
So then people who got like classical valuation training from, I don't know, working for investment bank, etc., they will know this is an extremely high multiple. Just for reference, the forward multiple of Nvidia is around, depending whose estimates you take, let's call it 30 times, maximum 35 times. So in other words, Tesla trades roughly 6 times at a 6 times higher or more expensive level than Nvidia, or almost 7 times Apple's forward earnings. So it would be so people who are classically trained, they would say, oh, this stock is extremely overvalued. But I think that's kind of, I think that's wrong. And I was classically trained. I was trained at Goldman Sachs to do corporate valuation, etc. And the way to look at it is, if and experienced people notice, every stock has its own trading level, because the classical way of valuing a stock is actually, you look at similar companies and you look at what level they trade at, and then you use, I don't know, an average or median, depends on the situation, and then you apply it to the company you want to value. And if we did this to Tesla, the stock, the implied value would be, let's call it roughly $80, $100 maximum. But this is missing a big point, and every stock has a slight premium or discount. In Tesla's case, the situation is that it has a huge premium because of Elon and certain other things, but it's mostly, I would call it the Elon premium. And if you ignore it, you will always be wrong when you try to forecast where a stock could go. So my recommendation is to every investor, professional or otherwise, just skip what you learned at university or in your analyst training, and you accept that this stock trades permanently on a very high premium. And you can very clearly see this on this chart. Even before the current administration, the stock traded at a very high multiple, close to 100 times.
Yeah.
And since the new administration has maintained for a full year over 180 times forward earnings. So this is just a key point to keep in mind. If you don't accept this trading level, you will always be off in the stock, as many have been over many years, and a lot of short sellers have been materially burned by not getting this important point. So now we have the multiple. With the multiple, we of course need earnings. But I wanted to touch on another point that is very important. People always say you cannot predict Tesla's price movement. This is true in the short term, but if you zoom out a bit, I think you can actually predict the price movements when you apply a methodology like the one I just explained to you, because it has two major components. One is the multiple, and the multiple captures the sentiment. If the sentiment is very bullish, the multiple goes up, and you can then see it in the data, in the median, etc. And the other component that you need the earnings. So when you add both together, you have the sentiment that reflects the multiple that reflects the sentiment, and the earnings. You can then plot the corridor. And I just want to show you a few things to basically prove this to you. Because I can talk all day long, but people may or may not believe me. So I wanted to show you some proof. So in February 2024, I predicted, and you can find this on X as a public post, that the stock would trade up to 300 by year end. And then I wrote a lot of stuff explaining the rationale. And in this explanation, I explain actually this methodology and argued that as future earnings will be priced in, stock would trade up. And then here, sorry for jumping around, here this red line marked this post, and then the stock traded up. And just for your information, people might say, oh, but AJ was only right because Trump won the election and then the stock soared. No, actually before the election, Tesla reported Q3 earnings, and that day Tesla already briefly touched $270. You can go and check on me. So basically in October in 2024, the stock was already at 270 and I predicted just under $300. So I was basically spot on. And what did I do? I did exactly this analysis, but with the calibration at the time. That's an important point. And then subsequently, when the stock got out of hand, sorry for jumping around, this was January 30th this year. I predict this is a long thread. This is my analysis of the Q4 results, and then I responded to this person and I predicted stock would sell down into April and then would trade up afterwards. And sorry, again, I have to jump around. This is exactly what happened. So this red line here shows when I posted this. Of course, I cannot post on X, oh, the stock is going to sell down because people will hate me and say I'm a Tesla bear. No, I'm not a Tesla bear. I'm a Tesla bull. But I want what everybody wants. I want more shares. And if you want to get more Tesla shares, there are only two ways to do it. One, you somehow find more capital to buy more stock, or you try to think about sentiment, earnings outlook, and you try to find buy points and sell points, and over time accumulate more shares this way. I try to do the latter because, quite frankly, I'm fully invested. I can't commit more capital to TSL.
So first of all, AJ, this is fantastic. I love whenever you do this because this is so unique and very thorough, because you do tremendous amount of research on the PE ratio, and then you actually do the earnings. And that's why this corridor, you call it, but you call it gray, but it looks like a pink median is going to go up, but that's in line with your analysis of earnings. But the PE ratio, I love that you actually put numbers to it, right? So 99 previously, and then now 138. So 130, 184. 184 is the median now. So it's like at least a number. And what you're showing is that, okay, if that's the median, and then you can see that you're way over. If it's way over, then either something's going to happen, or if it doesn't happen, it's just going to go revert back to that median. And so you kind of know it's the sentiment's overshot. Can you go back to the first slide though? So the very first slide though, just to, you are saying that in the next 12 months, you think that the price target's around 540, 600 per share?
Yeah, exactly.
Can you explain that? Because it's based on the PE ratio of just the basic 184, but also because of earnings going to shoot up next year, right?
Almost. The thing you really have to keep in mind always is always on a forward-looking basis. And so when we talk about the 12 months price target, first of all, we talk about November 2026, right?
Right.
And what you have to keep in mind is you have to keep in mind the earnings from that point in time forward looking. And that basically means we're talking about 2027 earnings. For the most part. That is the key insight.
Love it.
That is the key insight. Yeah. And the same is true for the 24 months price target. It looks outrageous, $1,000, almost $1,200.
Actually 3 years from now.
Exactly, because in 2 years from now, we have like inside 2028 earnings. That is the key insight. And when it comes to the multiple, I'm not touching the multiple. Like when you get trained in investment bank, the one thing you're being trained to never ever touch is the multiple. The multiple is derived from the market, and you're not touching it. You're not thinking. You're never like people sometimes talk about re-rating. Yes, you can look at re-rating once you see it in the data, but you never ever touch the multiple. So in all my analysis, you see, I'm not doing anything to the multiple. It's only what I can derive from observable market data. Observable market data means share price.
But so can you let me ask that question on that one. Okay, if you go back to the PE ratio, how long would you say? Like here, an example here, right? It has been 12 months of 184 as the median, but previous to that, it's been 3 years of it being 99. Like when do you actually say, hey, first of all, it's not going to be 35 like NVIDIA. It's been 99 for 3 years. But when do you think, okay, this is semi-permanent versus it being just a blip?
Okay, I think, and again, this is, I don't want to be political on these videos, but I have to talk about it. I think, and this is not a secret, I think a lot of people think or view that the current administration is a lot more friendly to everything Elon than the prior administration. And I think this is a big part of why you see a significant uplift in the multiple, and this is also exactly why you see the multiple never reach that level previously. I mean,
But
all these.
AJ, can't that be explained simply by the fact that FSD and robotaxi solved? Robotaxi launched, and everybody can now test it and goes, okay, they solved it. Versus many years ago, it was like questionable.
Yeah, I mean, I would think so. But if I look at when exactly the multiple took off, like crazy, because you can also
Right.
counter your argument by saying, well, Tesla can produce the most perfect FSD ever, but if a hostile administration puts artificial obstacles in their way, it amounts to nothing. You can have this cynical view, and I know for a fact some investors had this view. They were arguing with me, Tesla can achieve whatever they want. The current administration, this was over a year ago, they will never allow them to basically launch it. And I don't know, they may have been right, but we will never find out because the election turned out slightly differently now. And but when I just look at this chart and look at the timing, I see a very strong correlation with the transition in the administration. So going back to the initial part of your question, so about whether this is a blip, is this permanent or temporary? So my view is that as long as the political situation, and I think it's really all about Elon, doesn't change, the multiple will likely stay this high. Once robotaxis start to roll out and the stock trades up on those earnings, etc., the story will move on to global expansion of robotaxi, and of course the story will increasingly move on to Optimus. And once we see a few units Optimus running around in factories, we will see the story unfold. Moving to Optimus being globally available and things like that. So there will be an evolution that is, I think, quite obvious already. Once they start executing on this in a visible way, and as long as the political environment is not changing, the multiple will likely stay high. Would be my assumption. At least is what I can see in the data. So the biggest risk is then basically near term or relatively near term, it's the midterms. Should we see a significant loss in power of the current administration, this may also affect Tesla, because what people might start to price in is, that there's an increasing risk that we may have another administration in 2 years after the midterms. And then I think, depending who is the front runner, etc., we could see a weakening in the multiple. However, at that point, I think Tesla is on a very much stronger footing in terms of earnings, etc., because then we already, then at this point, once we talk about the next presidential election, a robotaxi should already be basically roaming around all major cities in North America, at least.
Yep. Okay. And then the good news is we've had early signs of Democrats, Olive Branch saying sorry, and maybe we'll see what happens.
Yeah.
But yes.
Just on that, because that is very important, that there is a completely plausible scenario that whoever is the front runner for the Democrats in the next presidential election might be someone who is very friendly to Elon, because he or she realizes that alienating Elon, who did so much for the country, might not be the best idea.
Okay, keep moving. This is great. Yeah. I love this analysis. So now we know that 184 PE is not terrible. That's a median, but anything over that, you got to think twice. Okay.
Yeah, exactly. So currently we are just touching the end of the one-time standard deviation. So that's 214 times. but again, you cannot compare this multiple to other companies because Tesla, because of Elon, is quite unique, and for that reason, if you apply other companies multiple, you will always be completely wrong. That's just the reality. So next, so now we talked about the multiple, and now we need to talk about the earnings. Because that's the other key ingredient that you need to construct a meaningful corridor. But and so now we look at the earnings curve. So the earnings curve here is this goes over many years. So you see what actually was reported by Tesla. Importantly, these are non-GAAP numbers. You cannot use GAAP numbers in Tesla's case. They're too noisy. For example, in these years, 2021, 2022, there was still a significant effect of Elon's first compensation package, where Elon was awarded shares. That's a non-cash item that completely screws up your earnings per share, and you need to adjust for that. And then basically, when we look at these future years, this is then basically based on my forecast, and so these earnings are underlying the corridor that you have seen earlier, and this is to arrive at these numbers on a forward-looking basis is basically where you spend 98% of your time working them out.
Yeah.
So let's talk about them. So now we go. So this is like the continuous view. So there's an extrapolation between each quarter, but on a quarterly basis, this is what it would look like. Here you have earnings per share diluted, non-GAAP. Up here you have from each after each quarter's EPS was reported, what's the next 12 months EPS. For example, if we look at this 216 in April 2026, so after Tesla reported the first quarter, the next 12 months earnings from that point in time will be 216. And these 216, you see here the calculation is 44 cents, 49, 63, 60. These are these 4 quarters.
That's 4 quarters.
So after reporting, and that's why you see here in the axis label, you don't see Q1, Q4 anymore. You see the months when the earnings are reported. So this is important. You need to make sure you get the timing right. And so you cannot build the corridor on calendrical quarters. You need to build them when the earnings become knowledge of the market. And that's why you need to build them aligned with the reporting dates. It's just a technical detail, but it's important. So then when we look at the earnings, so Tesla reported last quarter 50 cents. Keep this number in mind. This is going to be very important to understand the next point. And then I'm forecasting 53 cents.
Wow.
So an increase. So now let's look at what consensus says. So first of all, what is consensus? Consensus is just the average of the Wall Street analyst universe making forecasts for Teslas. This is roughly 34 different guys working for 34 different institutions. The number slightly varies quarter to quarter, but the average of their estimates is currently for the fourth quarter here, ending in December 2025, is 44 cents. And then in the first quarter, they forecast 45 cents. So interestingly, they think the first quarter is stronger than the fourth quarter.
Yeah.
Then when we compare this again. Huh?
It does make sense though, because usually the first quarter of the year is lower sales.
Yeah, but
they say it's higher.
A higher number.
Okay, sorry.
Exactly. No, yeah, fine. And so, but when we compare this now with my numbers, I forecast 53 cents and 43. So I actually. So keep these numbers in mind. So I'm substantially higher than the 44. I say 53, but then I'm more bearish than them on the first quarter. They think it's 45 cents. So what's going on? And for that, I want to go a little bit back in history, and we should look at what happened in the third quarter. So what I did. On the day Tesla reported, I posted this post and I said, okay, Tesla reported 50 cents. We just saw this in the chart. Wall Street expected 56 cents. So there was an error of 12%, and my estimate was 54 cents. And here, here under this blue, I cover up some key insight I will share in a second. And then we go back to just after Tesla released, or just prior Tesla releasing deliveries for the third quarter. So the consensus was at 50 cents. And this was my post from the big search right after quarter end, 2nd of October. So the consensus was at 50. But if we go back, ultimately the consensus trended up to 56 cents. But then Tesla reported 50. So people might say, oh boy, the consensus was spot on just prior to delivery. And then they made their forecasts worse with input from Tesla, basically with knowledge of deliveries. But that's actually wrong. So because what happened is, and sorry, I can't, because it's a presentation of, I can't remove the blue box. But basically what happened is, the reason why this is misleading is Tesla had a almost 300 million restructuring charge. And nobody forecasted for that. And that explained actually most of the deviation. So for example, if you back this restructuring charge out and accounted for the tax effects, Tesla would have reported 54 cents.
Yeah.
So my estimate would have been spot on, but I'm not trying to make this point to brag about my focus. No, it's not really the point. My point is to show you that Tesla's number was actually much better. It was 54 cents without the restructuring charge. And right now, like right around middle of November, we have not heard any news about Tesla doing more restructuring, because last quarter, in the third quarter, you know this, Herbert, Tesla consolidated its Dojo team and AI5 inferencing chip team. And this was the main driver for the restructuring charge. So that's a one-off item. And so the whole point is, so Tesla was at 54 cents. And so basically my forecast does actually reflect a reduction in EPS. So it's just important context for the next piece, because consensus looks now like really terrible. But again, this was a one-off item. So now we can go back to the next element. So now you see the bridge for my fourth quarter EPS forecast. So this is the 53 cents we just looked at. And this was actually what Tesla delivered. So Tesla reported 50 cents. The exact number is 0.502, if you want to be exact. And this bridge shows you what is actually driving the change from going from 50 to my 53. And you can see, hang on, where is it? Here's the restructuring chart. So the restructuring charts, because it's going away, it's not going to be part of Q4. That alone will add 6.1 cents. And then there was also some one-off stuff in SG&A spend. This will also add 5.5 cents. So there's some unwinds of some one-off negatives in the third quarter. And when I did my third quarter analysis, I reported on all of that. So there were a bunch of one-off items. So the Q3 was actually not as bad as what it looked like on the surface, but you had to dig into it a little bit. But there will be a big negative impact, and you can see this here. I expect that auto gross profit will create a 19-cent headwind, and the primary driver is on this slide. Here you see the bridge in deliveries. So Tesla delivered an all-time high of 497,000 vehicles in the third quarter, and that was driven by super strong North America sales, driven by United States, of course, because the EV tax credit ended. That created enormous demand pull forward, as I'm sure you discussed plenty with your audience, Herbert, and of course because the pull forward dragged some Q4 demand into Q3. I think it's entirely reasonable to expect that we will see a material demand trough in North America in the fourth quarter. And that creates a major headwind. And for example, I'm forecasting at least 25% drop sequentially. But keep in mind, Tesla just released highly aggressive leasing deals in North America. You can now have a Model Y for, I think from memory, for $480 a month, and
They got rid of the $3,000
no down
down
payments.
payment.
It's like a killer deal. If I was in the market right now, this would be highly tempting. And you can have a free option. So there's a killer deal, so this will partially offset the blow. However, I did anticipate when I made this forecast that Tesla would do something like that,
Profit hit.
because they need to keep the volume up, because the volume is important for fixed cost absorption. Anyways, so basically currently, and this forecast was made in the beginning of the quarter, I ended up around about 480,000 vehicles, so about only 17,000 units less. And the key driver you can see quite clearly here. I expect a very strong China quarter, which provides a significant offset. And the reason why I think China quarter will be very strong is we have basically the same or a similar situation in China as we had in Q3 in the United States. So what happens in China in Q4? It's the last quarter in which the Chinese consumer can get the full EV tax benefit. It's not nearly as generous as the tax credit was in the United States, but it has, depending on what type of EV you buy, it has roughly a $1,500 benefit, and this is an enormous, of course, incentive, and of course, a lot of Chinese consumers will buy the EV now instead of in the first quarter. And so this will be an offset. And then the other element is what we see in the Chinese market is the overall auto market does quite well. And we see an accelerating transition from hybrid vehicles to fully electric vehicles.
EVs. Yeah.
So we have this kind of double effect. So there's this demand pull forward for tax reasons, number one, and number two, the market for EVs is growing quite strongly. So you have these two effects, and that's why I'm quite bullish on China sales in the fourth quarter, providing this offset. But then there's another factor. So this data, I think we have never discussed before. So this is search interest for electric vehicles in China, and this is ranking. So this is measured by daily engagement on one of the leading auto
relative to each other. Relative to
each other, and you can see, with the exception of a few blips here, the Model Y was always number one. Only 3 times you can see there was a vehicle that briefly took the first spot. Then also the Model 3. Here in this
it's going up.
red line, it went up, went down, but kept a pretty strong ranking for a sedan, because of course, just like in every auto market globally, SUVs dominate, and to have a high ranking for a sedan is actually very difficult for that reason. And then when you look closely, this is a little hard to see in this slide, but there's only one brand in China that also pulls off that feat, and the feat is to provide to achieve consistently high rankings for their models. I know this is a really messy chart, but when you dig into it, and I spend a lot of time on this data, you can see that except for Tesla and Xiaomi, what all brands experience is that they, upon launch, they often achieve quite strong rankings for a week or a couple of weeks, but then they see their ranking fade. So the consumer is apparently losing interest quite quickly, except for these two brands. And now we get to another very interesting part. This is something we can look at later. So
this is great data. Great data. I mean, we do know, we've been saying for many of my shows, Jeff especially, Xiaomi is the real competitor. They could be they call it Model 3, Model Y killer, but not a killer, but they can certainly be the next brand. Surprisingly, is BYD is rarely even up there, right, in terms of interest, but they're a totally different segment. People are paying $5,000, $10,000, $20,000. So it's just a totally different market, isn't it?
Regarding Jeff is a subscriber of mine. So Hope
Okay.
he's not pissed off that I let people know. I'm
Okay.
the source for a lot of people, but that's a
That's
different
great. All
story.
right. That's great.
So anyway, so when we look at this chart, so first of all, regarding your point, the interesting thing about Xiaomi and Tesla is they actually sell at very similar price points.
Yeah, they do.
Xiaomi tries to just slightly undercut Tesla,
Hmm.
but they're effectively in the same price
Segment.
bracket.
Hmm.
And then so what does this chart show us? So this chart shows us trailing 3 months revenue generated with EV sales in China by model, and you can see Tesla. So this is as of October. So over the last 3 months, so would be October, September, August. Tesla generated just under $4.4 billion in revenue just with the Model Y.
Yeah.
And the Xiaomi U7, that's the SUV that was recently launched. That's why you see this
Hmm.
curve going up like a rocket. Brought in 2.8 billion, is number two most revenue generating EV in China. And then when you look at the number three, it was
Xiaomi.
the Xiaomi SU7, which is very comparable with the Model 3. It's also a sedan, brought in just under 1.9 billion. And then fourth is the Tesla Model 3, just under 1.7 billion. So there's a lot of similarity between these two brands in China. Both have only two domestically produced vehicles on the market, while all the others that also have high revenue produce a lot of different vehicles. When you look at this number 5 Geely, this is a very
Really?
inexpensive vehicle. Yeah, Geely Star Wish is the third, but this
Volume.
good. This exactly. This car sells extremely well. So they generate this number 5 ranking in total revenue for a model by very high volume, because this
Yeah.
is a very inexpensive, small, compact vehicle.
Hmm.
Um, but is also respectable performance. But then the other key point is then when you look down these rankings,
Yeah.
it very quickly gets very small, and very quickly nobody has even
Yeah.
1 billion. Most of them drop off very quickly, and that's the primary problem in the Chinese EV market. You have too many models, and most models
Yep.
just generate
So
too little
little. Hmm.
so anyway, so based on this data, the high search interest, I'm actually quite bullish for the fourth
Bullish.
quarter in China,
Yes.
and that's why I
Wow.
think it will not be as bad as as what consensus expects.
AJ,
Yeah.
you are the best analyst. This is just incredible, the work you did, and I was impressed with all your knowledge about the lease pricing, your knowledge about things that I cover every day. You took that into consideration, so there's nothing that's slipped by you. That's brilliant.
I'm very meticulous because my money is on the line. So the research I share with investors on X
It's crazy.
is just an output of the research I do for my own
Yeah,
investing, and so if I make a mistake, my money is on the line.
it's
So
great.
and of course, when you have skin in the game, you pay a lot more attention
Yeah.
than you would otherwise. I would say. Yeah.
Yeah, I think for example, the comment you made, or the insight that you made, that the Chinese EV tax credit is going away the new year. I don't know how many people knew that. I didn't know that. So that's very good info. Thank you.
Um, yeah. So this has been. It's not new. This has been around for quite some
I
time. It
know,
was.
but we
Yeah.
just don't talk about it. Like
Yeah. I think a lot of people. Let's be frank. People who. Okay. If you post something negative about Tesla, of course this will not get a lot of engagement. So that's why it's not very attractive for people who know about it to actually post about it. And people can lose followers over this stuff if they post it, because you know this, Herbert. A lot of people just get very hurt as soon as there's something that is not dopamine inspiring
yeah.
about the company they love so dearly. I also love the company, but I'm also an investor. I need to
Mm-hmm.
make sure that I,
Mm-hmm.
I don't buy at the wrong time, because again, in the beginning of the video, I said I want to discuss what everybody wants to know, and I claim that ultimately what every Tesla investor wants to know: how can I get more shares? And I hope in this video we discussed some elements that will help you potentially achieve that goal. And then also, when people always say, "Oh, you cannot predict the share," well, I think, let's be honest, it's just coping of the large number of average investors. But if you spend a lot of time on these topics and you analyze the data very carefully, I think you can find an edge.
Yeah, I think you can't predict what's going to happen to stock price, but what you can do is have some sort of probability. And
Yes,
so when the
exactly.
PE ratio is like 1.5 times median, the probability is higher that it will not.
Yeah.
It may go down. More likely, it's going to go down and up. Something can happen that makes it keep going up. No doubt, no doubt. But it's a lot
Yeah,
harder for that to happen. Yeah.
And just one kind of statistical consideration, and this is something the most successful hedge fund in human history has done, Renaissance Technology. When you look at this data, you always need to look at it on a cleaned up basis. You need to adjust for the noise. And by explain, let me just look at at this chart. At this chart again. So here is this bump.
Yeah.
This bump is when Elon bought Tesla stock.
Yeah.
This was an exceptional event.
Yeah.
I think Elon never bought Tesla stock. This was a first since he's CEO, since 2000, or actually 20 years at this point. So the point
that's not
is,
true. He bought it, and when I bought it in
did?
2012 for 95 million, he bought 95 million worth. I don't know if you call that stock. Yeah, it was stock because the stock was already public.
Okay, so I forgot about that. And thank you very much. I followed the stock since IPO, but I missed that one. Okay, thank you very much. So he did buy stock, but it was over a decade ago at this point.
Yeah, long time
So
ago.
I think we agree this was like an exceptional outlier event.
Absolutely.
So the point I'm trying to make is, when you have these exceptional outlier events, you should not discard analysis.
Yes.
If the analysis was not correct because of an outlier event, no, it does not matter. You need to adjust for that. That is very, very important, because if you look at data with all the noise, you will never see the signal. And that's why you will never be able to predict accurately attractive buy or sell points.
Okay. Yep. Those are very good points. Both the Trump bump and the Elon purchase were one-off.
This is
except you've explained why the Trump bump is not necessarily one-off because of
And I would just like to go back to the claim that you cannot predict the stock. Yes, you cannot predict the stock in the short term, but over a few months, you can have a good view of where it goes. If you adjust for these one-time effect that you cannot predict, like Elon buying the stock, and also other in prior periods. For example, there was this Hertz leasing deal announcement, which was like insane. I think the stock did like 10% on the day. But economically, it was a complete non-needle mover, really. But the stock soared. When you do analysis, you need to take out all these noise effects. Of course, you cannot forecast it. And I think when people talk about, you can't forecast the stock, one, I think it's coping. Number two, they mix up these noise events. But when you then look at it on a normalized basis, there are, I think, clear patterns where you can at least optimize your buying pattern.
Okay. Let's do more earnings, huh?
Yeah. So I think with that, I think there's a lot of things we can continue discussing. But I think that's... let me see whether I had more material left. Yeah, so this is the last slide. So this shows you actually the surge interest in Tesla in the beginning of the year when there was actually weaker demand. And you can see during this period, the Tesla Model Y actually lost quite a few times the number one rank.
Isn't that because they shut down the factory too? And they were...
no, the vehicle was already unveiled, and when you look down here and the scale, this was March, the vehicle was already delivered or was already in the showrooms. Okay. So this was already so here in the beginning. You're correct. Here it was unavailability of the new Model Y, but already from here there was a product available in China. So the reason why I wanted to show this data is that what happened, and I find it so interesting, is that actually the longer the new Model Y was on the market, the search interest improved. And I think it has to do with the fact that that people start seeing the car on the road. They see how cool it looks and how more modern, and this then makes them go back to the phone or computer and then search for it. But anyways, so that was the last slide. So if you have any questions, happy
What do you
to-
think is going to happen with FSD? So now that FSD version 14 is getting so good, will search interest will that start becoming a maybe not a ChatGPT moment or NVIDIA moment, but at least increase interest in the cars as slowly people realize, my God, this car drives itself?
I think the key thing that has to happen is you can sleep in the car, or you
can text in a car. I think that's the killer feature. I think Elon is right.
Yeah, whether you call it text, basically you can be in a state where you pay absolutely no attention for extended period of not just 30 seconds or 1 minute, where you can literally take a short, I always call it the nap feature. I think this will fundamentally change the utility of the product, because let's face it, at the moment, okay, the core problem of FSD right now is the following. We all, so basically 99% of the people who would be a target market already know how to drive. That is the key problem. So for us getting FSD, yes, it's safer, but let's be honest, safety is not selling it. It's
It doesn't sell.
comfort.
I agree.
It's amenity. Otherwise, everybody would buy a Model Y because it's the safest car, but we don't see everybody buying Model Y. They buy sometimes much less safe cars. We know that most consumers do not put safety first. So let's not pretend they buy FSD for safety. They buy it for amenity, and because everybody can drive. Right now, there's simply not enough of a pull, but the pull will significantly increase when I can sleep in the car. Or the other killer feature would be if I can send the car to pick up my daughter, my wife, whatever, that would be an enormous 10x increase in utility. And this would definitely drive demand, no doubt.
Yes. And then how does your model take that into consideration? If the PE is already at 180, I can't remember now, 184. If that's the median now, does it go up? Does it go down? If there's a new invention. So the reason why Tesla's PEs are so high is because they invent things. They invent things that are just boom, it's going to take over something.
Yeah, okay. Here we go back to the golden rule. Do not touch the multiple. It's the golden rule. That's the one rule in valuation. Bankers always joke about valuation is science and art, and it's true. But do not touch the multiple, because you have to think about it. All the things we talked about, a lot of investors anticipate all of that. And so once it happens, it's not news. It's basically just what everybody had on. I speak to a lot of investors all the time, and there's a part of the investment community. Basically, it's all as if cyber cap has already launched and is already plentiful in some high density markets in North America. And this is also, for example, people get always confused. Oh, why is the stock not trading up? Tesla just increased the robotaxi coverage area in Austin or something, and etc. And I always tell them, guys, this is exactly what you would expect. What was your base case? You expected Tesla to be stagnant, to be stuck in a small part of Austin for the next 6 months. Of course, every couple of weeks they will be expanding. That's the base case. So as an investor, what you should be thinking about is, okay, what is the increment over what is expected? That you can price in, but you should not double count. And when going back to your question, what happens to the multiple when the robo cybercab etc. launches, or when we get better features, or the NEP feature as I call it? You have to think about whether at this point in time this was already the base case, because just look at all the materials we see on X, etc. We can see on a daily basis basically the progress, the slight slippery slope progress. So there's a constant increase of the pricing in, and so by the time by the time we have the NAP feature, we probably expected it for a few weeks already at this point.
Yeah. Makes sense. Okay, so your price target right now is 12 months from now, 540, 600. That seems to be in line with, I mean, Dan Ives is at 600. He's one of the people that are most out there. And then next 24 months, so you're 1,000 next 24 months. It doesn't seem crazy. These seem to be pretty rational. And then are you still in line with, let's say, Kathy Wood, who says $2,600 by 2029, 2030?
Well, when it comes to Kathy, I have some views. I usually don't discuss Kathy Woods.
Okay,
very much.
That's fair. But in terms of your stock price, it seems to be fairly straightforward. Or does your stock price skyrocket the following 36 months, 48 months, or do you do that?
Okay, the truth is that when you do this type of forecasting, in most cases, once you go further out, 3 years, 4 years, you will be off materially.
Gotcha.
It just has to do with kind of the exponential nature. Like when you look at an exponential function, when you get the timing slightly off, you're completely off. That's the problem. Whenever you have like a very fast growing product, whether it's autonomy or Optimus, etc. If you get the timing off only by 6 or 10 months, your price target will be off quite a bit. And so that's why I think putting a lot of weight on price targets that are very far out, I think is a futile exercise, because the market is not trading on them. For example, if Cassie Woods puts out a 2030 price target of, I don't know, $3,000, $2,500, or whatever, it's futile, because today nobody trades on that. It's interesting, the argumentation, how she gets there, etc. This is something you can entertain, but it's not an actionable today item that I can implement in my trading strategy. Because ultimately my goal is to accumulate more shares without having to put up more capital. That's ultimately what I want to achieve.
So let's just carry forward. If I learn something from today, if based on the price today, this is the last dot here on this November 2025, it's on the first standard median.
Yeah.
What do you call it? Standard deviation.
Standard deviation, yeah.
So at this point, it's kind of like you don't know. It can go up and go down, but it's more likely probability it can go down.
Yeah, that's so. The point I would like to make is that this is the sentiment over the last 12 months, and as you can see, it captures a period of extreme exuberance, but also it captured a period of extreme depression relative to the current environment. So and I have this debate all the time with investors. You could also say, okay, what if you do this analysis just by looking at the multiple over the last 90 days? This might be more reflective of the current sentiment. So there are arguments for and against reducing the observed time frame. The argument for a reduced time frame would be that it captures the more current zeitgeist in the stock.
The economy, 100%. The macro.
Exactly. But the counter argument is it also would capture all the whims and the short-termism, etc. And if you use a longer time frame, you have more of the neurotic exuberance and then the depression. And so there's an argument for both. And then but this is exactly what I said before. When you do this type of valuation analysis, it's always where science, so the quantitative metrics, the medians, etc., standard deviation, the math meets art, where you have to make a judgment call. Like the 12 months is a randomly picked period. There is no law or no math that tells you, oh, you should pick 1 month. 1 year. 1 year just feels right because one year captures different seasonality, captures the different quarters. The quarters in the automotive industry are quite different, captures the financial year, things like that. So 1 year feels like long enough to be not too short-termistic, but not too long to capture like stale periods.
Yeah.
And stale periods for me would be everything before the current administration, for example.
Well, first of all, what I think that you do incredibly well, like you are probably, like you've shown, your data is the earnings. Forecasting earnings, you're very meticulous. You're very, you consider everything. And that one, I feel more confident that you won't be far off that. And then the PE ratio, what you're saying is you can't predict it, but hey, let me show you the corridor.
Yeah.
And if you apply the corridor to your earnings, this is what you're seeing here. And so you can almost like, yeah, I mean, you know what I mean? The confidence of the earnings going up is pretty high. And so by 2027, you're going to be somewhere up here in the 600, 700. And again, you're not far off. You're not like way off of, you're not so over bullish that it doesn't make sense at this point. So it seems fair. This is good. I like it. Yeah. This is great. I mean, you've done what you can to try to reduce the variables, and you're showing the variables here through the PE corridor. Yeah. Well done. I love this. I enjoy these kind of conversations with you. You do put in so much work. Thank you, AJ. Is there any last comments you want to make?
Maybe the last comment, and thank you very much for that, Herbert. So the beauty of this corridor is it brings together so much. I cannot even explain it. Like the model that is behind all these earnings, etc. It's like over 3,000 lines.
Yes.
And you have years of trading data, and so you have like enormous amounts of data, all compressed into something I think everyone can understand by looking at it just for a couple of seconds. Oh, this is the share price, and this is where it could be going. And this is not just pulled. This is not. And I want to make this very clear, it's not just some chart phrenology where people draw some lines, oh, here's a shoulder and here's a double donkey whip and now it means it goes up.
Yeah.
No, this is a completely different thing you're looking at. I just want to make this very, very clear.
Yeah. I love it. Can I ask you one more question? Hopefully it doesn't derail this whole thing. There are people who say PE ratios is absolutely inappropriate for a growth company and an innovation company. You don't need to look at PE. You just need to look at future cash flows and then bring it back down with some of the businesses, some of the parts.
I think this just shows whoever said this or says this, it shows their primitive understanding of PE ratio. So what people need to understand is if you do PE ratios properly, like you adjust for non-cash items, share-based compensation, things like that. That's why I always use adjusted earnings. None of the cash. It's a very good proxy for cash. Of course, it's not one for one, but it's in a certain relationship to cash, especially as you project out, because ultimately all valuation is based on the assumption of a normalized state, or sometimes called run rate. And so basically when you do multiples right, PE multiples, you can absolutely use them. And that's why I think that notion is correct at all. And I think this analysis, when you look at the corridor and how well it projected sell points or buy points, I think is basically proof that that's not correct, because what also these people, and again, I think this shows their ignorance, that there are very different PE multiples. For example, at Goldman's, in all our comps tables, we always had several different PE ratios. The one we always had was the next 12 months,
so
the
future
forward
future
PE ratio. But we had also a 2-year forward PE ratio, and sometimes 3-year forward PE ratio.
There you go.
And so basically, when
That's
people talk about when people talk about this and don't even talk about these elements, then I know instantly they have just very little experience in
Love it. This is a 3-year forward PE. Thank you for that. And by the way, I think what you've done is you've already, the response, that is a response to people who say, how could you invest in Tesla when it's a 199 PE versus, or 183 versus, NVIDIA, and then you've already adjusted for that. Well, this is semi-permanent. This is the way the stock has traded. There's various reasons. There's the Elon uplift. There's the potential innovation, blah, blah, blah. But then you use that, and then you very fine tune it to give the corridor so that you can kind of like give a 3-year kind of analysis versus just saying, hey, let's ignore it. Let's just look out 5 years, 10 years from now. Yeah. Okay. It's much more fine tuned. I like it. Okay. I've learned a lot. AJ, thank you. You're worth following. People should subscribe to you, as I've just learned today.
Most of my research is unfortunately behind paywall. I charge very, very little. People tell me all the time I charge way too little, but it's mostly to basically keep my comment section clean, because with a very small subscription fee, I can eliminate all the bots. That's a huge advantage.
Nature. Okay, so follow him on X at ALOJOH, and you can see his links, and you can subscribe to him there. Thank you, AJ. That was another great one. Perfect, beautiful. I hope people watch this and they learn something new, as always. Thank you.
Thank you very much.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.